Good evening, everyone. Welcome to the first webinar of 2017. So this is Wayne, Head of Research and Education. On behalf of Fullerton Markets, I welcome everyone, and hopefully this webinar will kickstart the year properly. So as usual, the webinar will be the same format for this year, unless you all have any suggestions. Feel free to email me. So I've done a survey. The format has been pretty well received, so I've decided to keep the format. So the first segment will look at what are the key events or news that has happened in the past 1 week. Next, we'll move on to the calendar for the upcoming week to see whether there are any news or data to take note of. And finally, we'll move on to the charts. And feel free to type in your currency pairs or the symbols that you want me to look at, plus the time frame, and we'll go on to the charts one by one. Let's jump straight to it. For last week, of course, the key data that we have is what pretty much the whole world has been looking out for, the non-farm payroll. And this would be an interesting year for Fed to watch out. To watch out for Fed, because the expectation is for them to increase rate 3 times this year. So just the dollar alone, we will not be lack of trading opportunities. To expect a lot of volatility in the market for the whole of 2017, especially for the dollar. And most of it will be driven by the dollar as well for this year. As you can see, as of now, the major theme will be driven by the dollar, not only by the Fed rate hike, but also after Donald Trump is being sworn in later this month. So currently he's still the president-elect. So once he is sworn in as a president, then we will be interested to watch out what he has to roll out for US, because the market has been anticipating. So anyway, back to our non-farm payroll. Last month figure was 156,000 versus the expectation of 175k. Just by looking this number alone, it is disappointing. And the unemployment rate went up 4.7%, but the main reason of the unemployment going up is because the participation rate went up as well. That means more people participated in this data. So that's why the unemployment rate went up slightly to 4.7% from 4.6%. Another key data that was released at the same time is the average hourly earnings. So that went up 0.4%. Slightly higher than market expectation of 0.3%. So if you look at these 3 data, 2 of the data fall short of expectation, or rather 1 of the data fall short of expectation, while 1 is pretty much as expected, and the other 1 exceeded the expectation. But because of the drop in non-farm payroll, the initial reaction was sell off in the dollar. And the initial reaction lasted in seconds. The main reason is because after they look at this trade data, market realized that the previous non-farm figure has been revised upwards. Okay. So this is a classic case whereby if any of you are trading non-farm payroll or like to trade the non-farm payroll, this is something to look out for. The initial reaction, chances is market will look at the current number, but do not forget the previous number as well, because there's a tendency that the previous number will be revised as well. Of course, it is not revised every time, but once in a while it does happen, like last Friday. So the previous number was 178,000, revised up to 204,000. So that was a big revision. So that's why because of the revision in the previous number to a much better number, which caused the initial sell-off of the dollar to reverse. So for those of you who have been watching the charts, you will notice that the euro dollar in the first minute, the initial move is 40 pips upwards, and subsequently in the same minute after the data is being released, price dropped, erased the gain and dropped another 30 pips. So of course the move is not in the range of like 100 to 200 pips. The main reason, of course, even with a good number, it doesn't really change the expectation of a three rate hike. So market will not change the expectation upwards for now, if you ask me, because it's already 3 for this year. So it is the chances of it being revised up to 4 times a year, it is quite slim at this moment, unless the situation really progress towards more rate hike in 2017. But at this point in time, based on data, based on events, there's nothing so-called pushing it for 4 rate hike a year. So do take note of the upcoming non-farm payroll and the events, especially the proposal that Donald Trump is going to roll out after he is sworn into office, which is later this month, 20th of January. Okay, so that's non-farm payroll for last Friday. And of course, for last week, we have also seen the UK PMIs. There are 3 PMIs being released. So these 3 PMIs scored a hat trick. Okay, so for those of you soccer fanatics out there, hat trick means scoring 3 in a row. So it's called a hat trick. So for the UK PMIs, all the 3 PMIs, manufacturing PMI, construction PMI, and services PMI, all 3 outperformed the expectation. All 3 numbers came in better than expected. This report is released after the services PMI, which is the last PMI that is being released last week. So the data came in 56.2, okay, which is well above the forecast of 54.7. So the chart below will show you that the white color line is the services PMI, whereas the blue one is the composite PMI combining the other 2 PMI. So as you can see, the PMI has been rising since the 3rd quarter of 2016. So it is, in terms of data wise, UK is performing well. So for the whole of last week, the sterling has been strengthening, but it lost its ground towards the end of the week. So the sterling fell sharply towards the end of the week, and the main reason is the market is still very much concerned with Brexit. Not so much whereby the court ruling will rule that parliamentary approval is required and all this. Their concern is whether Brexit will be a hard exit or a soft exit. Definition of soft exit is good for UK, meaning that they keep most of the benefit while exiting the EU. Hard exit will be, like the word imply, will be a tough time. That means some of the benefit will be taken away in order for UK to gain the benefit of determine their immigration policy, which is the reason for Brexit. So in order to gain something, chances is they have to give up something as well. And that something that they are likely to give up is the access to the single market, which is Europe. So if they lose the free trade access, that means chances is their economy will be impacted, and that will be bad news for the sterling. So market is concerned about how hard is a hard exit. So at this point in time, There's no way to access, so it is just guesswork at this point in time. So until UK PM Theresa May invoke Article 50 and we have some negotiations in progress, then the drama will slowly reveal itself. So as mentioned, since last year after the Brexit referendum, to prep everyone, this Brexit drama is far from over. So it will continue for another at least 1 to 2 years. So it will be a long drawn kind of a drama to watch out. And the good news for us trader is as long as there's drama in the market, there's plenty of volatility and trading opportunities for us. Of course, the final, the last noteworthy kind of event was one of the biggest last week as well, besides the non-farm payroll. It is in sort of intervention by People's Bank of China, the Central Bank of China, PBOC. So basically, they restricted some of the supply of yuan, and that caused the yuan to appreciate across the board. So the Chinese yuan is very close to the 7 level. That means $1 to 7 yuan. So this level has not been broken. That means it has not gone beyond 7 in the last 8 years. So it is yuan is weakening quite a fair bit. Of course, the main reason is Trump economy and also the expectation of Fed rate hike that strengthened the US dollar. So with the weakening of the yuan, China is experiencing capital outflow. So money is flowing out of China at a pace whereby it discomforts them. So they have to do something. So what they do, they reduce the supply flow of the yuan. So we see the yuan shorting up, strengthening. So it strengthened as much as 1.3%, around 1.3% in just 2 days. Okay, the biggest move since last seen in August 2015. So even for offshore yuan, of course the Chinese yuan is not freely traded on retail market yet, but the offshore yuan, which is the symbol is CNH, it is available on a Fullerton platform as well. So USD CNH, if you have seen the chart, it has dropped more than 1,700 pips in just 2 days. So of course, the main reason is because the Chinese yuan is weakening. So if throughout the entire year of 2017, there will be plenty of chance for yuan to weaken again, especially when Fed start to increase interest rate, or when Donald Trump really propose some aggressive stimulus which is being approved and will be implemented. So in that case, US dollar will strengthen, and that is likely to bring the dollar CNH back to the 7 level again. So if that happens, possibly with these precedents, maybe PBOC will consider to intervene in the market again. So to watch out, that would be interesting to take note of, and maybe there will be trading opportunities for some of you as well. Of course, the tricky part is for PBOC, usually they don't announce their intention in advance, so that will be a bit tricky for us trader to catch that kind of move. But having said that, of course, if I personally find that it could be an opportunity somewhere, I will highlight for your consideration during the weekly webinar as well. So that's so far wrap up the 3 so-called worthy events and news for last week. So let's move on to this week's calendar. So for this week, data is pretty there's not much of tradable data in our opinion, but we'll just highlight a few just for your consideration. The first one will be tomorrow, Tuesday, January 10th. The timing is 8:30 a.m. GMT plus 8 time zone. So for the benefit of some of you, GMT plus 8 time zone is basically the Singapore, Malaysia, China time zone. So 8:30, there will be the Australia retail sales. So market is expecting 0.4%, a pretty decent number. So the suggestion over here would be a pending long Aussie dollar if the actual number is greater than 0.5%. So Aussie has been releasing pretty decent data recently. Because of China's slowdown, then the Aussie is affected as well. That's number one. And of course, the strengthening of the dollar. The two reasons that is forcing the Aussie dollar to be heading downwards in the last few weeks, or rather in December onwards. So for this data trading, so suggestion is if the figure is greater than 0.5%, meaning if the retail sales come in 0.6% or more, possibly to keep this pending long order on the Aussie dollar. Else you can just delete it when the news is being released. So another key thing to take note of, on Tuesday, Fed member is scheduled to speak. For the entire week, there's a few members scheduled to speak, 5 members scheduled to speak in 6 speeches throughout the week. So in our weekly research that is being released in the afternoon, you can access it through our Fullerton Markets website under Research and Education. You will have read about the speeches that we highlighted to be aware of, because whatever they are going to say will definitely have a certain impact in the market depending on what they say. But for us, we are expecting them not to deviate too much. Chances is they may still express their optimism towards the stimulus that Donald Trump is going to release, and also at the same time express certain concerns over the global uncertainties, especially Europe, China side. So all in all, they will maintain look and observe and see so-called bias for now. So of course they won't change their plan of 3 rate hike at this moment. There's no reason of them scaling down the expectation. At this moment, it's still early part of the year. So they will still, chances is they will maintain status quo to avoid unnecessary volatility in the dollar. So next on Tuesday, we see that the UK have interesting data, which is the manufacturing production. 17:30 hours on Wednesday, 11 January. So the market is expecting good number, 0.5%. So our suggestion is put a pending long on pound yen if the actual data is greater than 0.6%. So why pound yen instead of pound dollar? The main reason, of course, is in the strength of dollar. As you can see, the pound dollar has been dropping since later last week, and it has really erased all the gains that is being made during the 3 PMI's release. So if you ask our preference between a sterling yen and a sterling dollar pair, we will prefer to put a pending long on a sterling yen instead. So this is the suggestion, pending long sterling yen if the actual data is greater than 0.6%, meaning it has to come in 0.7% or more to keep this pending long order. Else, if it doesn't fulfill the criteria, then remove the pending order. So that will be on Wednesday. The next data will be on Friday, which is the core retail sales of US, as you can see highlighted on the screen. So X automobile. So that is the core retail sale minus any automobile sales, which is the car sales, because tendency car sales tends to be volatile. So this would be the interesting data to watch out for. So market is expecting 0.5% in the retail sales. So here's a suggestion. If the actual number is less than 0.3%, meaning it has to come in at 0.2% or lower. So this is a pending short dollar yen. So the reason for this suggestion of a pending short dollar yen is in the event if the actual data really falls short by so much of the expectation, there's a chance that market may start to scale back on rate hike, or they will delay the expectation of rate hike to second quarter or even later. So if that kind of expectation happens, there's a possibility that the dollar will weaken against the yen. So this is the suggestion of pending short dollar yen if the actual is less than 0.3%. So this will be the data for this week, and of course on Friday, as you have noticed, two of the FOMC member, including Fed Chair Janet Yellen herself, is scheduled to speak as well. One in the morning 0800 and the other at night 22:30 hours. So before we move on to the charts, okay, just like to highlight the accelerator has for the new year, we are still going to continue with our most popular promotion for now. So if you have not opened an account with Fullerton Markets, feel free to do so and take advantage of this very popular so-called promotion. And if you want to find out more about the details on this promotion, you can always visit our website, fullertonmarkets.com/promotions, and all the terms and conditions are laid down on the website as well. It is very simple and straightforward. So for this promotion, you can get up to US dollar 10,000 for free. So do not miss this chance. Next, we'll move on to the charts. So for this, please type in the symbols that you want me to look at and the time frame as well. Okay, so I'll look at the first symbol on my screen. The first symbol is actually dollar yen H1 and H4. Okay, both the time frame of H1 and H4. So let me just open up dollar yen. I'll just choose one time frame, be it the H1 or H4. I'll see which time frame looks better for me to give my opinion. Okay, I'll go for the H4 time frame. I'll mark some levels that I see on the chart at this moment. Okay, basically what I'm marking on the chart again is the decision region that I am anticipating. So possible those are the region, the price region whereby I expect the market to make a decision whether to continue higher or lower. So usually I'll put it to pretty much the round numbers. So the first level in the middle, 116.60, which is the current level, and the upper resistance 118.30 and the lower support at 115.20. So this is basically the regions that I'm seeing. So for dollar yen this week, only the speeches and towards the end of the week, retail sales that will possibly cause some volatility in the dollar yen. Else we do expect the dollar yen to remain in sort of this range. We don't foresee any reason of it breaking out of 118.3 or breaking down below 115.2 at this moment. So the suggestion for this pair is really to use any range trading strategy. Okay, that's our suggestion. Any range strategies that you may be aware of, possibly you can apply to trade the dollar yen for this week. So if not, then one of the possible trades to look out for just by this chart alone, I will zoom in so that it is easier to see the candlestick. We have a look at the overall picture now. So now I'll zoom in to pinpoint the actual level where possibly you could look for entry for a trade. So like I mentioned, 116.60 is the decision level that I'm seeing. So one of the possible trade idea would be, once it closes into the blue box, if a candle closes there, which is around 116.27, plus minus a few pip in that region, possible to consider going short. Okay, that's one. Of course, the other suggestion would be, if market doesn't close into the blue box, so you just hover around 116.60, and if you see any bearish candlestick formation that goes into the region of around 116.90 plus minus, that kind of region. Oops, just give me a moment. Okay, if there's a bullish engulfing pattern or any bullish candlestick patterns that gives an entry around 116.90 plus minus, possibly you can consider to go long. So that would be my two suggestions for dollar yen, unless you have your own range strategies to apply, then you may apply the strategy accordingly to look for any long and short trade. So my comments I'll put here. Consider going long after bullish candlestick formation. Okay, so this is the two suggestions for dollar yen H4 chart. I'll put a vertical line, so this is the current candle. So we can do a review next week. Okay, what I'm doing here, I'm taking reference to the tail of the candlestick to refine my entry for the short. So it may be missed by 1-2 pips, but just to be precise, slightly more precise. Okay, so you'll be in the range of 116.23 plus minus, thereabout. That will be the entry, possible entry to go short. Of course, the potential target would be before it hits into the resistance and the support region. That would be at least the first so-called milestone for any trade that I take. At least I usually set the first milestone before it hits into any support or resistance. So this would be the dollar yen. Okay, next I'll move on to the next symbol, which is pound Aussie daily chart. Okay, let me open up the pound Aussie daily chart. Okay, what you see here is a pound Aussie daily chart. Pretty much in general, it is a downward movement since, as you can see, I try to scroll back a bit to the chart. You'll notice since third quarter, since the start of third quarter of 2015, thereabout, plus minus, sterling has been under pressure, losing ground to Aussie all the way. So if you are trading the daily time frame, it will be a mid to long term kind of chart. So for mid to long term perspective, that will be something to watch out for in the first quarter. So first quarter, the thing to watch out for is the court ruling. To see whether the court ruling will rule that parliamentary approval is required for Brexit. But the market is more or less expecting that there will be approval required, but approval won't change the fact that UK is heading for Brexit. The only thing it may result in is some delay due to the processes to get approval and things like that. It's just delaying. But ultimate fact remains that UK will still exit EU based on the result of the referendum last year. So even if UK parliamentary approval is required, chances is you won't see the sterling strengthen too much. Rather, you will still be under pressure, as the main worry is UK will lose access to Europe market, and the economy is likely to suffer, and the chances of that happening would be pretty high at this moment. because to gain certain things, I don't think their EU counterparts at this moment would let them have all the benefits. They have the benefit of determine their immigration, who to come in and out, and at the same time maintain access, free trade access to Europe. I don't think their EU counterpart will be so kind to them at this moment. So the chances of hard exit is quite likely, and the only question is, what is the impact of hard exit? How hard is it on the UK economy? At this moment, no one is able to access the impact. So that's the reason sterling has not weakened even further. So if someone is clear of the impact and depends on the degree of the impact, sterling could be heading lower or higher as well if the impact is not that serious as what they first anticipated. So in any case, pound Aussie, with the background information in my head, I will be looking to short pound Aussie instead. And since this is a mid to long-term trade, shorting pound Aussie has an added advantage. Aussie at this moment is still having a higher interest rate compared to sterling. So let us look at one thing for pound Aussie, the swap. Okay. So as you can see over here on the screen, you will see a swap long and a swap short. Swap long is negative 15.2, meaning if you hold a long position overnight, you will need to pay $15.20 US per lot. And if you go short, you will earn $2.36 per lot every night that you hold your trade. So on Wednesday, of course, the swap is triple. So if you are holding a short position, you will make interest along the way with your trade. So of course, the interest may not be a lot, but it is still interest in a positive note. So just to give you an idea, if you hold a trade, one lot for 1 week, so the easiest way to calculate what is a 1 week swap short, let's say you're holding a short position, whatever figure you see over here under swap short 2.36, you just multiply by 7. That will be the swap for 1 week. So if you multiply by 7, a quick calculation, that will be around $16 US per lot in 1 week. So if you are holding, since this is a mid to long term possible trade, if you are trading on a daily chart, if you hold it for 2 weeks with 1 lot, it will be about $33 US. So some of you, if you are quick in your calculation, you will notice, oh, $33 on 1 lot is not really a lot. So it could be the amount for about 4 pips or so. So 4 pips in 2 weeks, it is not a lot. But like I say, this is a slight bonus only. So in any case, so if you are holding a swap, if you are holding a short trade on a pound Aussie, if you hold it across days and weeks, you'll be slowly earning little interest along the way. So for daily chart, okay, I'll mark the decision region for your consideration. I'll zoom in so that it is easier for you to see after we have seen the big picture. Now we'll zoom into the more micro level. Okay, this is roughly the price regions that I will be considering as a decision region, whereby the market will decide where is it heading. So the three levels at this moment is basically 1.7150, 1.6850, and 1.6550. Okay, the blue box there would be the price for you to consider. If candle close into the blue box, that would be your consideration to go short. And of course, the ultimate so-called support, which is way below over there on your screen, is about, which is around the round figure of 1.59. So if you have taken a short trade, of course, before 1.59 will be the region whereby you can consider taking profit or closing at least partially for your position. So this is the first consideration. Of course, if the price, for whatever reason, there are temporary good economic result coming up that may possibly push the sterling upwards in short term. So if the price hit towards the level of 1.6850, at the level, then you can see how the price move and consider going short if price rejects. There's a sign of price being rejected over at 1.6850. So how to look at this area? So you will not be a perfect kind of picture whereby, oh, the candle just nice touch or fail to close beyond 1.6850 and start to turn downwards. So chances is the body may cross slightly above and hover around here before deciding where it should go. So once price hit towards that region, you have to refine your entry and use some candlestick patterns trading methodology to assist you. So typically I'll just look for bearish candlestick formation. Okay, look for bearish candlestick formation. Some of it is basically a spinning top, a doji if it's a three candlestick formation, or a bearish engulfing. So once we see that formation and just nice there's a bear candle closing into the blue box, that will be the time to consider to go short. So this would be the two suggestions. Of course, for some of you who are relying on indicators to trade, that is perfectly fine as well. So the suggestion for you would be at those decision region, if you are using any indicators, when price is near the decision region, example, if it's close to 1.6850 plus minus, and there's a signal on your indicator to go short, then possibly you could consider going short. At the same time, same thing for the first suggestion to go short. Instead of relying on a candlestick to close below to go short, if you have indicator that tells you at that point in time it's a good time to go short, it is a confirmation for you. So depending on what indicator you would like, that would be a suggestion for you to apply those indicators as a confirmation as well. So this would be the pound Aussie. Based on fundamentals, our bias is bearish. So that's the reason we suggested these two possible entry. So let's look at the next symbol on my chart. Pound dollar M30. Okay, let's look at the pound dollar M30. Pound dollar M30. Okay, good. Let's look at pound dollar M30. Okay, so this is a pound dollar M30 chart. It has been falling quite sharply since late last week, Thursday and Friday last week. It has been falling pretty badly. So this is the overall picture. I'm going to zoom in so it's more visible on your screen. So at this moment, this is the M30 chart. Okay. If I look at the candlestick price action, let me zoom out a bit just to look at any possible levels. Okay, no clear-cut levels to take reference from. So I can't find any so-called clear-cut decision regions to help me determine where to go long or short. But in general, our bias is, for this week at least, so our bias is to look for short opportunities. So the question is where to go short. So after such a sharp drop, without any major key event this week, there's no major central bank announcement from both UK and Fed, Bank of England and Fed, and data may not have such major impact on this currency pair as well. We do not foresee the pound dollar to just continue plunging down. Of course, that is just our expectation. So, but we always react to the market instead. So one of the possible way is aggressive. Okay, this is considered an aggressive entry. Okay, a breakout trade. So this is a aggressive short suggestion, meaning why is called aggressive short? Because you are selling at a lower price. Okay. So expecting it to go lower. So it's considered aggressive because you are selling at a low price instead of selling at a higher price. So if candle close below 12140 into the closing price is into the blue box, which is around 12128 plus minus. Okay, into the blue box. Okay, that would be the consideration for you to go short. Of course, some of you do not prefer such an aggressive short. It is too low for you, which is fine. This is anticipating a breakout to continue. So for some of you who are looking for a more conservative short, meaning for the price to go higher before selling, then possibly you could employ an oscillator indicator to tell you objective entry. Okay, why do I use an indicator? Usually, if I can't find any decision levels based on price action chart, then an alternative for me would be I'll rely on indicator to tell me a possible entry to go short. So this is M30 chart. I don't use a lot of indicators. Typically, I only use, occasionally I use moving averages, but most of the time if I use any indicator, it will be stochastic. Okay, for those of you who know me long enough, this is almost the one and only indicator that I use most of the time, if not all the time. Of course, a disclaimer over here, we are looking at the M30 chart. So I'm employing my trading system on M30 chart, and typically I don't trade M30 chart. I usually trade H1 or H4 time frame. So how does stochastic work on M30? It may not work according to how it worked for me in H1 and H4 chart as well. But just the theory part of it. So for stochastic, it is overbought region here, which is a selling signal. So a possibility it could be an objective entry is wait for stochastic to hit into the overbought region to give me a selling signal to sell the pound dollar on M30. So this would be the second alternative. So my comments, possible short when stochastic is in overbought region, which is marked by the blue box, which is above 80, between 80 to 100 of the stochastic. It is called the overbought region, which is giving a selling signal. Okay, that will be a M30, which is still a short bias. The next symbol on my screen is Aussie Dollar. Aussie Dollar H4. Okay, let's look at Aussie Dollar H4. Okay, so this is Aussie Dollar H4. I'm going to, this is the overall chart. Sharp drop, consolidate over here at the bottom. So you notice based on the chart, the key support is over there. Which is about the 7160 kind of region, plus minus a few pips. So I'm going to zoom in, okay, so that the candlestick is bigger. So as you can see, the price has retraced upwards and more or less consolidating. Okay, the Aussie dollar after losing much ground in December. So after consolidation, managed to regain some lost ground. So the data out of Australia at this moment is still pretty decent. The main concern is still China, their largest trading partner, which is expected to have slow growth this year as well. So possibly their GDP for this year could be even lower than 6.5%, which is their objective set last year. So it could be lower than that, and they are okay with it because it is the price, sort of the price to pay to transform their economy to a more domestic dependent economy. So it'll be interesting once China completes its transformation to balance their economy to have a more domestic consumption reliance. But anyway, back to Aussie dollar. Currently, Aussie dollar is sort of in a consolidation. So I'm going to mark the consolidation region. Okay, since the tree shadow is pretty much around the same level, I will shift the decision level slightly higher. So it will be 0.7350 and 0.7290. So this is pretty much 60 pips kind of range. So for those of you who wants to trade the range, possibly you could consider scaling down to H1 time frame. So this is the first suggestion. Scale down to H1 time frame. So scale down, so the one suggestion is to scale down to H1 lower time frame and apply a range strategy to trade within 0.7350 and 0.7290. Okay, that is first suggestion over here. And then of course the other suggestion would be to trade beyond the consolidation region. So the first suggestion is to trade within it. Then of course the other two suggestion is basically to trade out of it. So if the price close beyond the consolidation region, there you can consider long and short respectively. So about plus minus a few pips, that will be the box region, 0.7366 about, so it's about 15 pips higher than the decision region if it close into the red blue box there. And the blue box below, that will be also about 15 pips lower than 0.7290. So if it close into the blue box, possible to consider going short. So this would be the suggestion for Aussie dollar. Both within the range and beyond the range. Next symbol that is on my chart would be on my screen, sorry. It will be oil. Interesting. Let's look at oil. Okay, that is oil on H4 chart, just to give you a big picture. As you can see on H4 prices is there's no clear direction on a H4 chart. Is pretty much has been consolidating since last month. But the request is to look at M30 chart. To me, M30 and H1 chart is more or less pretty similar, because two M30 chart, M30 candle is equivalent to one H1 candle. So as you can see, if I scale it to a H1, it looks like this, and M30 it looks like this. It is more or less similar in a way. So I'll just choose one that I can have clearer levels. Okay, I'll just stick to M30 as requested. More or less the same. Okay, the 53.50. Okay, for oil, a bit on the fundamentals for this year. So they have OPEC has announced output cut in November last year. So they announced, and now it's follow through. So market will be keen to monitor the situation as to how well the OPEC country follow their output cut agreement. They are supposed to cut 1.2 million barrel a day. So it will be interesting to see if they are able to fulfill or stick to that output cut agreement. So if they are able to stick to it, of course, oil price is chances it will maintain at the current level. But failure to stick to the output deal, we could possibly see oil price heading downwards towards $50 or even lower. So oil price at this moment, it is very much unclear in terms of the direction. No clear uptrend, downtrend whatsoever. But like I mentioned, this would be one of the key decision level. That is the nearest decision level to watch out for. So once price goes beyond 53.50 into also about 15 cents below 53.50. So that will be a consideration for you to go short on oil. So after you go short, of course, the first milestone would be before the price hit into the support, which is around $52.80. Okay, once price hits close to it, maybe $52.90 or 88 cents, that will be the time for you to, that will be your first target. Okay, first target, you could close out all your position if you choose to, or if you think that there are news or events that that you believe that you will push the oil price further down. Example, failure to adhere to the output cut agreement. That would be if the news is out, that would be an event that we believe oil price to push oil price lower than this $52.80 level. So in that case, in the first target, you may not want to close out all your position. But in the event there are no such news being announced or comments being announced and the price is in the first target, then you have reason to believe that maybe $52.80 is a support for oil, and you can consider closing out all your positions and look for the next trade. So that's the first target for oil at this moment. So that's the short suggestion. As for the long suggestion, okay, I'll take the pause over here as my guide. Okay, the pause, as you can see, after the drop, there is a bull candle here to pause the price before it fell further. So this is what I call a pause, and a pause is a telltale sign for me to suspect that could be another decision region over there, 53.80, $53.80. That will be a decision level. And if the price goes beyond it, that would be around $53.95 thereabout. If the price close into that region, then possible to go long. So that's my suggestion based on the decision region that I see. So that's oil for me. Next currency pair. Okay, before I move on to the chart, let me take a quick question. There's a minimum, the question is minimum investment required to open account. Okay, for Fullerton markets, we accept funding as low as $200, $200 US dollar or equivalent. So that's the amount that you need to invest in the minimum amount you need to invest in your trading account. Okay, just to clarify, it is not an account opening fees. It's basically the amount you need to fund into your trading account and you can trade with it. So it is the minimum funding is US dollar 200 or equivalent. Okay, back to the chart request on my screen. Okay, it will be Euro Dollar daily. Okay, Euro Dollar daily chart. Let me open the Euro Dollar daily chart. So this is pretty much a Euro Dollar daily chart. Okay. So it has been creeping downwards, but recently it has more or less gained some ground and consolidating. So let me zoom in to refine the region. So for Euro Dollar, if you ask me, there are a lot of speculations that it may head towards parity or whatever. But at this moment, we don't foresee that happening, unless at least the first thing we want to see is the first rate hike from the Fed. Okay, if without the first rate hike even realizing, I don't think there's much chance of euro dollar heading to parity unless there's a fresh crisis out of Europe. So at this point in time, we don't expect that. So the fresh crisis may be French election. Okay, if you ask me, of course the other unforeseen crisis, I don't have crystal ball, but anything that possibly could happen, if you ask me, slim chance. French presidential election, which is towards the end of first quarter this year. So in the event their populist Le Pen got elected, she is one of the anti-EU populists as well. And if that happens, and French also hold a referendum to exit EU, then that could be the catalyst to push euro dollar towards parity. But anyway, that is just pure speculation. What's the chance of that happening at this moment? It's just a possibility. How probable is it? We don't know yet until at a closer date of the election, when a campaign and some polls start to happen and we have a clearer idea the French is inclined towards which candidate. But back to euro dollar, at this moment, as you can see, euro dollar is very much in a consolidation, and at least for this week, we expect euro dollar to be in a consolidation as well. So price is around 1.0520, which is very much the decision region over here. So to trade the daily chart, I'll need the price to close into this region before taking a short trade. Okay, which is around 1.0480. This is a 40 pips difference. So you'll notice, wow, why does it need to go 40 pips beyond the decision region? Okay, because this is a daily time frame. So when you go on a daily time frame, the amount of pips becomes less significant. Example, if you trade 40 pips on a M30 chart, it is quite a significant move. Or if you trade it on a M1 chart, it is a big move for 40 pips. But if you trade it on a daily chart, 40 pips is like 3 pips on a normal H1 chart. Because if you go on a higher time frame, chances is you will be taking a slightly looking at a bigger move, typically in the 100 of pips region. So of course, if you have taken that short trade over there, the first target would be before 1.380. Chances is you will be near the round number of 1.04. Okay, that's the first target. So this is about, if I do a quick measurement, a possible 80 pips kind of trade. And this is quite small on a daily chart, as you can see over here. But you can't force a trade. I always determine my target based on what the chart tells me. It doesn't mean that, oh, when you are trading the daily chart, you should take at least 300 pips. But if the chart is telling me a story that the first target, the first support is at 1.380, there's no way I can force the trade to go 300 pips. I will just react based on what the chart tells me, and make my decision accordingly. Okay, so this is euro dollar. Okay, I'm still on short bias. Okay, typically because of the divergence in policy, ECB is still on easing mode. They have just extended their stimulus, and Fed is on a tightening mode. So based on these two different directions that the central bank is heading, that's why I'm on a short bias for euro dollar. So this is the suggestion over here. And my apologies, there are a lot of requests on my screen that I may not be able to handle all of them. So in the event that I have not answered or taken your requests, my apologies. I'm going to look at the one last chart before I move on to some announcement. So the chart would be gold. Gold chart. Okay, what you're seeing here is a gold chart. The request is a daily chart as well. Oh, we have a lot of high time frame trader. So gold chart is over here. For those of you who have managed to read our research for this week, one of our picks we have selected is the gold chart, and it is a daily chart as well. Coincident? So I'll just reiterate whatever is being mentioned is in the research, but for webinar I'll give slightly more details because the research is quite high level, giving some bias and direction, that's all. So for webinar we'll go slightly more detailed. So basically for gold, this is the Fibonacci level that we have drawn, and just nice prices reached the 23.6, which is also a decision region. Some traders like to use Fibonacci to denote support and resistance. So for me, I treat it as a possible decision region as well, because to me support resistance is also a region whereby market decide where it wants to go. So Fibonacci levels are also to me decision levels. So 23.6. Okay, so I'm going to zoom in after I mark this so that the candlestick is more visible. So to refine the entry, okay, if the candle close above which is around 119, if I'm not wrong, 119, 1192, 119, around 1191 plus minus. Okay, if it price close to 1191, possible can consider to go long. Of course, for gold to continue heading upwards, it would mean that chances is it would mean that the US dollar weakens further. So at this point in time, the only possibility of US dollar weakening further is the data is bad, and Donald Trump did not release any exciting stimulus after it sworn into office, so it disappoints the market expectation. So if it disappoints the market expectation, chances is market will start to sell the dollar. So if they do so, gold price may start to head upwards. So at this moment, none of that is happening. So if you ask me whether it will close into 1191 at this moment, it is quite unlikely. But I do not want to predict the market. I just want to react to it. In the event candle close above in the 1191, that will be a consideration to go long. So the other way around, Okay, since you notice there's a long bear candle over here, no, sorry, long bull candle followed by a short bear candle over here, a pause, and price now is heading upwards. So the short opportunity would be if the price close below. Okay, the body of the candle is around 1172. So if the price close below, which is around 1168, we give it slightly lower. So if the price is able to close into 1168 region, then possible to consider to go short. So daily chart. So we are looking at the daily chart and looking at possible close to decide, which means if you are trading this, you just need to look at the chart once a day. So it's very simple. Doesn't take up a lot of time. But the trade-off is you don't get a lot of trades. So that's usually for traders who are trading high time frame. It requires lesser monitoring. At the same time, it gives you lesser trading opportunities. So there's always pros and cons to everything. So that's the gold chart for you. So that's pretty much we have gone through 7 charts this week. Okay, so next week we will review all these charts and see what the market has done. Okay, this is a classic example why I need a candle to be closed in the blue box before taking a trade. So as you can see, the shadow of the candle has touched the blue box. So if you are too impatient, doesn't wait for confirmation, then you will realize that you would have entered a short trade already and now price is retracing back upwards. Okay, what I'm marking is all the red lines, so it's easier for us to review next week. Okay, so let me make an announcement before we end off tonight's webinar. So the good news for those of it's the start of the year, I have some good news for those existing client of Fullerton Markets. Our research team has produced a short write-up, basically a 2-3 pager write-up. The title is 7 Trading Teams for 2017. So it has 7 trading teams inside to prep everyone for the entire year. So it is a very easy to read material. It's a 2 to 3 pager only. So it is available for all our Fullerton clients. So all you need to do is to log into Fullerton Suite. And you click under Documents. You will see one of it is called 7 Trading Teams for 2017, and you can download it. And of course, for those of you who are not our clients yet, very simple. All you need to do is to register a live account with us and fund. There's no stipulated amount as long as you meet the minimum funding of USD 200, and you will be able to access these free downloads as well. And for those of you who are new to us, this is not the only download available to you. We have tons of videos available, MT4 videos, Forex videos, and the full archives of all our weekly webinars available to you as well. You can view it at your own free time. So we have the weekly webinar has started since last April. Every week is being archived in Fullerton Suite, and you can watch it live online at your own sweet time. So that's the benefit, one of the benefit that our education and research team provides or value add to our customer. Of course, if you have any suggestion that you feel that you'll be beneficiary to your trading journey, you can always write in to me or to our support team. You can just put in your suggestion through our live chat. Okay, so feel free to download, and please download. It is already available in Fullerton Suite under Documents. So we have come to the end of tonight's first webinar to Kickstart 2017, and I'll be looking forward to seeing you in our next webinar next week, and hope that you have find this webinar beneficiary. If you do so, I would appreciate some kind words, since it's the first webinar for 2017. Give me some compliments to kickstart my year as well. Your words will be my energy. Okay, so this is Wayne signing off on behalf of Fullerton Markets. I wish everyone, may the pips be with you for the entire week and be a profitable week for all of you. So good night and bye bye. See you in the next webinar next Monday, same time, same channel.